It begins with a silence that feels almost deceptive. Markets calm, analysts quiet, and yet beneath the surface something trembles. For holders of the Iraqi Dinar and Vietnamese Dong, that silence could soon shatter. The week of October 1619 is not just another set of dates. It carries the weight of growing speculation, quiet warnings from financial insiders, and the unmistakable tension of markets bracing for change. Over the past few weeks, global economic observers have noticed subtle but significant movements, unusual trading volumes in emerging currency markets, shifts in oil pricing patterns, and renewed discussions inside the corridors of the International Monetary Fund. While no official announcement has been made, the convergence of these signals has sparked concern that a major currency event could occur, possibly shaking confidence in both the dinar and the dong. Investors who have long waited for a potential revaluation or stabilization now find themselves standing on uncertain ground. The Iraqi dinar, a currency burdened by decades of conflict and political instability, has always carried with it both promise and peril. The country's economic reconstruction efforts, bolstered by oil exports and international partnerships, were supposed to pave the way for gradual strength in the currency. However, recent data coming out of Baghdad paints a more complex picture. Inflationary pressures are quietly building. Oil revenues have seen temporary disruptions due to ongoing disputes over export routes in the Kurdish region, and the Central Bank of Iraq's foreign reserve strategy has raised eyebrows among economists. The bank's decision to tighten currency controls, limit certain cross-border transactions, and re-examine private bank operations may indicate internal stress that has yet to be publicly addressed. Analysts from regional financial institutions suggest that Iraq's current fiscal posture is designed to defend the dinar's existing value, not prepare for an upward adjustment. This subtle distinction could mean the hopes of a near-term RV revaluation might not only be misplaced but dangerously overhyped. Meanwhile, in Vietnam, the story unfolds with equal complexity. The Vietnamese Dong has been one of Asia's most closely managed currencies, guided by a cautious and methodical central bank. The State Bank of Vietnam has long balanced foreign investment interests with export competitiveness, keeping the Dong stable within a controlled range. Yet, recent trade data shows widening pressure on that balance. Exports have slowed, manufacturing output has dipped slightly in key sectors like electronics and textiles, and regional economic slowdowns in China and South Korea have begun to ripple through Vietnam's supply chains. Compounding this are quiet concerns about the strength of the US dollar. The dollar's continued dominance and rising yields have strained emerging market currencies across Asia, with the Dong among those most exposed to these shifts. As a result, financial experts warn that rather than appreciating, the Dong could face renewed downward pressure if global liquidity tightens further during mid-October. The significance of the October 1619 window is tied to several converging global events. The World Bank and IMF are set to issue updated regional outlooks. Oil market futures are approaching an adjustment cycle, and multiple central banks, including the U.S. Federal Reserve and Bank of Japan, are expected to release policy comments. For currencies like the dinar and dong, whose values depend heavily on international confidence, any shift in these larger institutions' tone could have an amplified effect. For example, if the IMF's upcoming report highlights instability in Middle Eastern fiscal systems or renewed risks in Southeast Asian manufacturing, speculative holders may rush to liquidate positions, driving volatility. Similarly, a hawkish statement from the Federal Reserve about maintaining higher interest rates could strengthen the dollar, thereby reducing demand for riskier emerging currencies. Adding to the tension are unverified but persistent rumors circulating among global trading networks, suggesting that several regional banks have begun quietly restricting foreign currency exchanges in specific denominations of the dinar and dong. While there is no formal confirmation, anecdotal evidence from private investor groups points to delays in settlement times and tightening liquidity across certain online currency platforms. If true, these signs could indicate that financial institutions are preparing for a potential wave of instability, or at least anticipating short-term disruptions in convertibility. In essence, what looms ahead in mid-October is a test of both patience and perspective for investors. The dinar and dong markets have long thrived on speculation, with optimism often outpacing fundamentals. Yet this moment feels different. It is not about rumors of sudden revaluation or hidden global deals. It is about the quiet tightening of conditions, the recalibration of expectations, and the subtle shifts in sentiment that precede larger financial realignments. The coming days may not bring an immediate collapse or miraculous breakthrough. They will likely define the tone of what comes next. For those holding on to these currencies, October 1619 may be less about fortune and more about foresight, a reminder that in global finance, silence often comes before the storm. As the week of October 1619 approaches, analysts across financial centers in London, Dubai, and Singapore have intensified their monitoring of both the Iraqi Dinar and the Vietnamese Dong. Behind closed doors, reports are circulating that institutional investors have begun quietly repositioning their portfolios, favoring safer assets while scaling back exposure to speculative currencies. This movement, though subtle, signals an undercurrent of unease. Traders who once dismissed the dinar's volatility as routine now view recent market behavior as a possible warning of deeper structural stress. Likewise, the dong's controlled exchange rate, long praised for its stability, is now being re-examined as the global financial climate becomes increasingly unpredictable. Economists point out that even the smallest disruptions in confidence can set off chain reactions, especially in markets where liquidity is thin and sentiment-driven speculation runs high. For Dinar and Dong holders, these next few days are shaping up to be a moment of reckoning, a time when the optimism of past years meets the hard realities of global economics. In Iraq, the situation remains delicately balanced. The central bank continues to emphasize its commitment to price stability, foreign reserve strength, and monetary discipline. Yet beneath that official tone lies a struggle against multiple headwinds. Oil, the lifeblood of Iraq's economy, is facing new geopolitical pressures as global production deals shift and regional tensions threaten supply routes. With the price of crude fluctuating near sensitive thresholds, Iraq's budget calculations are once again being tested. A lower oil revenue intake could weaken fiscal stability and put renewed pressure on the dinar's fixed value. Moreover, whispers within Baghdad's financial circles suggest that government ministries have delayed certain payment schedules, potentially hinting at temporary liquidity constraints. For a country whose monetary credibility depends on consistent fiscal management, such delays, even if minor, can send ripples of concern throughout international markets. At the same time, global observers note that Iraq's foreign exchange auctions, a key mechanism used by the central bank to regulate currency supply, have shown signs of irregular activity. Volumes have fluctuated in unusual patterns, and reports of stricter transaction monitoring have surfaced. Some analysts interpret this as a preemptive move to prevent capital flight or to curb speculative trading in the dinar. Others see it as a reaction to external pressures, perhaps even quiet requests from international financial bodies urging Iraq to maintain transparency and compliance with anti-money laundering standards. Whatever the cause, the result is a tightening of currency flow just as investors seek clarity, leaving many uncertain whether this represents a defensive maneuver or a precursor to more significant monetary adjustments. Meanwhile, in Vietnam, the atmosphere is similarly cautious. The State Bank of Vietnam has been active in open market operations, quietly intervening to ensure that the dong remains within its intended band. However, currency strategists warn that the country's export-driven economy is facing headwinds as global demand softens. A slowdown in major markets like the United States and Europe has dampened export orders for electronics, garments, and agricultural products, all vital sectors for Vietnam's growth. Foreign direct investment remains solid but shows early signs of plateauing, and remittance inflows, an often overlooked stabilizing factor, have not grown as strongly as expected this quarter. These indicators, while not catastrophic, add up to a pattern that could make it harder for the government to sustain its currency defense if global conditions worsen during the October window. Adding further complexity, international capital markets have entered a phase of recalibration. Bond yields are rising, the dollar index continues to hover near multi-year highs, and investor sentiment toward emerging markets has cooled considerably. When such macroeconomic forces align, even stable economies can experience pressure. For the Dinar and Dong, currencies operating within politically sensitive and globally exposed frameworks, this creates a perfect storm of vulnerability. Experts caution that if the U.S. Federal Reserve signals another rate hold or hints at a delay in monetary easing, the ripple effects could strengthen the dollar further, pulling capital away from emerging currencies. In that case, both Iraq and Vietnam would face heightened challenges in maintaining stability, especially if speculative activity increases during this period of heightened uncertainty. Despite the mounting concern, it's important to note that not all analysts foresee a crisis. Some argue that the current wave of caution is part of the natural rhythm of global markets, a phase of adjustment before eventual stabilization. They point out that both Iraq and Vietnam possess substantial foreign reserves and have demonstrated resilience in past episodes of volatility. For Iraq, the long-term goal of rebuilding institutional trust remains intact, supported by ongoing reconstruction and oil sector reforms. For Vietnam, the nation's expanding digital economy and growing regional trade ties could help offset short-term fluctuations. However, even these more optimistic voices admit that mid-October could act as a stress test, a point where policy decisions, global sentiment, and market behavior intersect in ways that reveal underlying strengths or expose hidden fragilities. In this unfolding scenario, ordinary holders of the Dinar and Dong find themselves in a familiar but uncomfortable position, waiting for official statements that may not come in time, waiting for currency platforms to update rates, and waiting to see whether this moment will validate their hopes or challenge their assumptions. The atmosphere feels tense yet restrained, like the quiet before a storm that may or may not arrive. Whether this period marks a turning point or merely another wave in the ongoing cycle of speculation remains to be seen. But one thing is certain: the days of October 1619 will not pass unnoticed. For those invested emotionally or financially in the fate of these currencies, the calm now feels too fragile, too precise to trust completely as October 1619 draws ever closer. The sense of quiet anticipation surrounding the Iraqi Dinar and Vietnamese Dong is intensifying into something far more focused, a collective watchfulness that feels almost historical. Across financial networks and social media, discussions have reached a fever pitch, but behind the noise lies a sobering truth: markets rarely move on speculation alone. They respond to data, confidence, and the perception of stability. And right now, both the Dinar and Dong stand at a crossroads defined by those very elements. International analysts describe this moment not as a collapse in motion, but as a pressure phase, a time when the smallest shock, whether geopolitical, fiscal, or institutional, could set off significant consequences. The stakes are clear: either the currencies weather the global turbulence with resilience, or they falter under the growing strain of uncertainty. For holders worldwide, this is not just a financial concern. It is a test of patience, perspective, and preparedness. The broader global picture underscores why these dates may hold weight. In Washington, the IMF's upcoming assessment on regional financial stability is expected to highlight the dual challenge of tightening monetary conditions and persistent inflation across developing markets. If Iraq or Vietnam is mentioned in a negative context, such as concerns about transparency, debt exposure, or fiscal management, it could immediately sway market sentiment. Simultaneously, in the Gulf region, oil ministers are preparing for a crucial policy meeting aimed at addressing recent volatility in crude prices. Any decision affecting oil supply or pricing will ripple directly into Iraq's fiscal projections and, by extension, the perceived strength of the dinar. Economists suggest that Iraq's dependence on oil for over 90% of its state revenue makes it exceptionally sensitive to even minor changes in energy markets. Should oil prices dip unexpectedly during this mid-October period, Baghdad's ability to sustain monetary stability may come under renewed scrutiny. For the Dong, the challenges are different but equally impactful. Vietnam's growing integration into global supply chains means that any slowdown in export demand, particularly from the United States or Europe, can immediately translate into currency pressure. The recent reports of declining factory output, though modest, may be enough to spark caution among foreign investors. Yet, amid these external factors, the human element remains constant. Thousands of private investors, both in Iraq and abroad, have built their hopes and financial strategies around the possibility of a currency breakthrough, a long-awaited revaluation or official rate adjustment that could reward years of patience. For many, the Dinar and Dong are more than speculative holdings. They represent belief in economic recovery, in the idea that nations emerging from hardship can one day stand strong in global markets. But reality, as analysts often remind, is not driven by sentiment. Currency valuation is shaped by policy discipline, fiscal transparency, and global trust. Without measurable economic reforms or external support, dramatic upward shifts are rare. The concern among experts is not simply that October could bring bad news, but that the persistent cycle of unrealistic expectations may lead to emotional and financial exhaustion among retail holders who have waited for years. Still, not all indicators are bleak. In Iraq, there have been quiet signs of structural progress, incremental steps toward digital banking modernization, the introduction of new compliance systems, and talks with international auditors aimed at increasing transparency. These efforts, while small, signal that the central bank is aware of its credibility challenges and is attempting to address them. Similarly, in Vietnam, the government's long-term vision of economic transformation continues to attract global partnerships in technology and infrastructure. The nation's stability-oriented fiscal management has earned cautious respect from neighboring economies. These factors could help both countries absorb short-term volatility if the mid-October window triggers market disturbances. Analysts agree that what matters most in the coming days is not dramatic announcements, but measured responses. A calm, coordinated reaction from central authorities could neutralize much of the speculative pressure currently circulating in online communities and trading forums. As these events unfold, financial media outlets are preparing for rapid coverage, and investors are setting alerts for rate changes in official communications. The world will be watching, not necessarily expecting a crisis, but anticipating movement. It is in moments like this that markets reveal their true nature, less about luck or timing and more about resilience and adaptation. The Dinar and Dong have both survived turbulent chapters before, from political upheavals to regional shocks, and each time they have found equilibrium, even if not at the levels their holders dreamed of. That resilience, quietly built over years, may again prove to be their greatest asset. For now, the message remains steady and sober. October 1619 may or may not bring visible changes, but it will bring clarity. Investors will see which rumors hold weight, which data proves true, and which hopes endure despite uncertainty. And when that clarity comes, whether it confirms fears or restores confidence, it will reshape the narrative around these currencies for months to follow. For those watching, the best course is not panic, but awareness, to stay informed, to separate fact from speculation, and to remember that global markets reward patience far more than haste. And so, as the countdown continues, one truth stands unshaken. This is not just about the dinar or the dong, but about how people respond when uncertainty meets opportunity. In the end, those who navigate this moment with insight and composure may find that even in the absence of dramatic revaluation, there is strength in understanding the story as it truly is. So, if you're watching this right now, stay alert, stay grounded, and keep following the data. Because in the days ahead, the headlines may change everything, or remind us that patience, once again, remains the most valuable currency of all.